Okay, welcome to week 2, Finance 231. Again, my name is Dave Shipley. I facilitate this course and excited for another exciting session tonight and a holiday session at that. So thank you for being here, Marianne, Christine, especially on this holiday. Don't know if any of you had the day off as far as work is concerned, but it is a pretty big national holiday, and hopefully you were able to celebrate the holiday in your own way. Hopefully this class isn't the way that you're celebrating the holiday tonight. So, oh, Marianne, I think you're not alone. I think most people did have to work today. Um, and of course, I'm working tonight with you. But yeah, I hope you'll find a way today to do whatever you'd like to do for the holiday. Yeah, boy, that's the truth, Marianne. Sleeps for no one, right? So, a couple things we want to accomplish tonight. We want to do a quick review of last week, the first week in the course. We want to look ahead and talk through the coursework that you're going to have for this week. We'll go through as much as we can in chapters 3 and 4, although I'll tell you now, chapter 3 is fairly long as far as the slides, and there's a lot of good material. Chapter 4 is about risk and reward, and it does get repeated. I shouldn't say it gets repeated, but a lot of the elements of chapter 4 get reviewed in future chapters as well. So although we're not going to have a lot of time to cover chapter 4 tonight, is my guess, we will be able to review it some more next week when we go on to future chapters. So don't be alarmed if we don't get through much of 4, but we should be able to get well on our way into chapter 3. So just to reiterate, some of you have asked again about the ebook. I think I sent out an email and made an announcement, and hopefully that was clear, but there is not an ebook for this course. The material that you need for the discussion board, the checkpoints, and the assignments each week is provided as far as either required readings, just articles that are online, or in case of the assignment this week, for example, you can do some research online like you normally would for a topic to complete a paper, and that will be sufficient. I also have already posted chapter 3 and chapter 4 slides to the announcement board, and I will post this session as I normally do as a recorded session under the session link. So you'll be able to re-review the content here. So we'll get through most of chapter 3 tonight. We'll spend a few minutes at the end like we do each week on the assessment for this week. Especially important without the ebook to make sure and make notes as far as the material that is going to be covered on this week's assessment. This week is kind of like a midterm. It covers the material from last week and this week, and there are 20 questions, so a few more questions. It's also worth more, about double what last week's test was worth. I know some of you probably didn't get the score that you wanted on last week's test. That's consistent in every single course I've ever taught. There are always a handful of people who didn't get as good as they wanted to. But I thought that the overall scores, most of you passed last week's assessment, and I feel like the assessments in this course are a little more difficult just because they didn't provide us an ebook. Having said that, that's not a crutch. We shouldn't dwell on that. We shouldn't think of that as something that's going to prevent us from getting the grade we want. I will give you the material and topics, as I mentioned last week, that you need to know. Some of these questions are just tricky, and so it's not about being able to get the right material. Sometimes it's just about how carefully we read the problem and how much time and effort we put into the test. So I would focus on those kinds of things for this week, really reading the question, trying to understand it the best you can, making sure to cover all the topics that we tell you will be on the assessment tonight here at the end of class. And then if you get caught throughout the week, going over those topics and not really feeling like you're understanding anything about that topic, that's where you zip me a quick email and say, hey, this topic is really not working for me. Where can I look for some additional information, or what can you tell me, to kind of give me a little bit of further direction before I get to the test, okay? And I'd be happy to provide that. You could also go into the learning coach session or the tutoring session by Lindsay Hawes, and she'd be happy to review some of the material topics as well with you if you come in and give her what those material topics are, right? So those are some different ways that you can prepare this week for the test. But I thought overall the test looked good. I've mentioned on the announcements board already tonight that all your grades have been graded. It's all completed for last week already. So anything that you turned in on time should already have a score on it. I've given you feedback. Hopefully you can understand that feedback. If you have any questions about the feedback that I gave, zip me a quick email once again. Let me know that you're concerned or that you have a question about the feedback that I gave, and we can discuss it further. Most of the time, it's pretty straightforward. If you followed the instructions, followed all the rules associated, with the assignment, assessment, or discussion board, then you get the credit that the effort shows me that you should get. And there's always opportunity with assignments and discussion boards. If you didn't do enough content, or you didn't get your responses in, or something like that, I always give you the chance to continue to improve your score by showing additional effort. So let's say last week you're one of a handful of people that just didn't get the responses done. You got a main post in, and then the weekend just caught up to you, and you had too many things going on and couldn't get the responses in. That's okay. Go in and do the responses. You can't get full points for them, but you can still get most of the credit, and I would encourage you to do that. It's an easy way to improve and to show effort and get a few extra points. Any questions about that? Any concerns about how we, redo assignments or input additional information into discussion boards for extra credit if we didn't get full points the week before? Okay, pretty straightforward, but like I say, if you have any concerns or questions, let me know. Zip me an email. Let me know right away so that we can get on top of that. I thought the discussion board last week was excellent. I think you did a great job. Y'all, that was a great discussion board. I appreciate comments that were made. I think this week will be another good week on the board. It's a very topical situation that we're discussing on the discussion board this week about going online to do your investing. It's becoming more and more common. It's becoming very easy. It's becoming very low cost, and so it's an interesting, I think, a very interesting discussion about thinking about investing online. So, okay, Marianne, if you have any concerns after you check your feedback then or grades, let me know. So, so that's this week's discussion board. It should be pretty fun and interesting to think about and to do a little bit of research on about online investing, because, like I say, that's kind of the direction of the future as far as online investing is becoming just more and more popular. A lot of times it's used as a supplement to somebody who's using an advisor for different reasons, and we'll kind of talk through that a little bit tonight and a little bit on the discussion board. But it's just becoming a more commonplace and a more flexible and convenient place for some people to do trading and to do investing. So that should be an interesting discussion. That's what the discussion board is this week. As far as the assignment this week, the assignment asks you to think about and discuss the difference between future value and present value as it pertains to investing. Okay, and so it's kind of a short, it kind of has a short answer feel to it, short answer question feel to it. Like, hey, you could just write a couple lines, give the definition of future value, give the definition of present value, and be done. If you were to do that, though, I couldn't give you full credit, right? We've got to explore that a little bit more, do a little bit of research, perhaps read an article or two, give some feedback on what they say about how present value and future value pertains to the topic at hand, which is investing at this point. And if you do that, if you read some information and get some feedback on that, I think it'll be a pretty straightforward assignment, just a few pages, again, 750 word requirements, about 2 to 3 pages, as you found out last week, of writing. And most of you, those of you who did turn in the assignment, did a great job. Most of you got full credit for it. So I appreciate your efforts there. If you find yourself in a situation where you haven't turned in the assignment, those assignments are worth more than a third of your grade. Please, please, please get caught up as fast as you can. Obviously pace yourself, right? Don't try to get everything done in one night, but as soon as you possibly can, start to allocate time so that you can get caught up and get those points. So this week's assignment, like I say, future value versus present value. We'll talk a little bit about it tonight, but really it's going to be about going out and researching a little bit about what different resources have to say about what future value is as it relates to investing and what present value is as it relates to investing. And one of the things that would be interesting to think about is to consider this most recent lottery. The 1.5 billion that everybody was excited about and going crazy about. By the way, if we had anybody in our class that was one of the 3 winners, I think they're probably not going to join us anymore in class, right? So they've probably quit the class on us, and they're thinking through and really, strategizing how they're going to spend their $500 million that they're going to get. But the point that I was trying to make is you had two options, right, on the lottery. If you won the lottery, you had two options. You could either take a lifetime annuity where they'd pay you every month or every year, over your entire lifetime, or you had the opportunity to take a lump sum. And if you took a lump sum, you got a lot less, right? Maybe you don't know about this situation, but if you take a lump sum, the published lottery amount is going to be a lot less than what you thought it would have been. So even though they announced that every one of these three winners is going to get over 500 million, if you were to take the lump sum, you might get something more like 380 or 400 million, which is still a crazy large amount, right? But significantly less, 20, 30% less than what the published amount was. That published amount is based on taking income over a lifetime, okay, over 20 or 30 or 40 years. So the reason I bring that up is because it's an interesting exercise in future value versus present value, okay? A dollar today is worth more than a dollar next year because I can take that dollar, get interest on it, and get some kind of return. So it's worth more for me to get a dollar today that I can invest and increase and get interest on than it is to wait a year and then get a dollar, right? So when somebody's evaluating whether or not to take the lifetime income versus the lump sum, they've got to do a present value versus future value analysis, okay? Because they need to determine for themselves whether or not it's more valuable to take it in a lump sum and then invest it or do something with it today versus taking it over time and getting more if you were to take it over time. And Marianne, great point. You can never guarantee. You might die tomorrow, right? And so somebody might be thinking, well, I'm just going to take my money now as much as I can get and live it up, right? Because who knows if my health will hold out or if I'll be able to enjoy it 10 years from now. One of the things that they do, though, just as a heads up, is yes, it's guaranteed over your lifetime, but they also have a guaranteed amount that's going to come, right? So even if you pass away, your beneficiaries would get whatever that guaranteed amount is. So it's not like you lose out on it if you were to pass away tomorrow, but you yourself, having passed away, lose out on the opportunity to have fun with that money, right? If something were to happen to you, somebody else is going to have fun with it, not you. So they do guarantee you that you'll get the full amount. It just is stretched over your lifetime, and then if you don't live to what they calculate to be your mortality or your lifetime, then they would go ahead and give it to your beneficiaries or the remainder balance to your beneficiaries. Just like if you'd have taken a lump sum and then died, that lump sum, of course, would pass to whoever you dictated, as your beneficiaries. Okay, so that's an interesting, and you could bring this up in your paper, right? You could take a paragraph or two and talk about the lottery and research out how that really works, how they pay out the lottery, a present value, which would be taking the reduced amount, right, in a lump sum, versus the future value, which is taking the total value over, that annuity payment over your lifetime, which is stretched out, but a bigger amount in the end. Okay. So anyway, that's a something you could think about or something you could write about. The other thing you could think about or write about is what's referred to as net present value for business owners. Net present value is an interesting corporate finance issue. So if you've taken a corporate finance class before or an accounting class, you might have heard of the term net present value or NPV. But NPV is the basis for a lot of financial decision making. For management and for ownership of companies. They'll do what's called a net present value analysis, and they'll determine based on present values of future benefits and present values of costs. So they convert everything to present values, both costs and benefits, and then they weigh those costs and benefits in terms of present value to determine whether or not they should take on a project or not, or to evaluate one project versus another. Okay, so net present value is another concept related to the assignment this week that you could do a little bit of research on and write about. I'm just trying to give you some ideas so that you don't run out of things to write about. Like I say, you got to have 2 or 3 pages. So there are some different concepts that you could add in and kind of supplement to your research that I think could be fun or interesting to learn about. Like I say, net present value is critical to corporate decision making, and something like the lottery is always kind of fun to research about and just find out some things about. So anyway, as long as it doesn't make you feel sad or jealous that you didn't win, right? Because we don't want to make you miserable. We just want some interesting information and interesting topics to cover. So there you go. So that's this week's assignment. Any questions about the discussion board or the assignment for this week before we proceed? Well, you still got time, Marianne. So, if it's not this one, I'm sure here in a few years we'll be talking about another, multi-million-dollar Powerball again. This one was so successful. I promise you they'll continue to do it. Exactly. And it actually just adds on itself, right? The more successful and big they get, the more people are going to participate, and the more often they'll probably do them. So I would guess that we'll see another one of those in the near future. All right, so let's go on to Chapter 3 and give you some feedback. Chapter 3 is going to be very helpful as far as the discussion board topics for this week. Now, if I don't leave us at least 10 minutes for the test, it won't be enough time. So I'll try to be cognizant of that or aware of that, and we'll try to wrap up by about 10 till so that we can have adequate time to cover all the material for the test. But as I was stating before, Chapter 3 is a great preface or cornerstone piece for what you're going to need to know for this week's discussion board. This week's discussion board, as we mentioned, you could just go online and research out, online investing. But this week, the slides and the chapter really go into a lot of detail about what the benefits, advantages, and potential disadvantages, pros and cons of online investing and online information is. So let's go into Chapter 3. It's got a few goals that potentially could be our goals. I don't think we need to read through those. We don't always get to all of them. So we've got a couple things as far as just getting started with investing. A lot of people, when I teach investment courses that are specifically about personal finance or investing in the market, a lot of people's feedback will be, I've heard about the market, I've heard about investing, I've had friends that have invested, but they'll say something like, I just don't know how to get started. I don't know anything about it. I don't know how to do it. I don't want to get taken advantage of. I don't want to, I don't have a lot of extra money, so I'm just not going to do it because I don't know how to start. So one of the things that the slides talk about is just getting started. How to just, get your feet wet. Just get started a little bit so that you can do something, but not necessarily jump head first and get yourself in trouble either. So a couple of the ways that you can do it are to go to different sites like the Investing Online Resource Center, the InvestorGuide.com, Motley Fool, CNN Money, Yahoo Finance, Google Finance. All these different companies are a great resource to somebody who's just kind of getting started with investing. I think one of the very best investing education sites that's out there now is Investopedia, actually. So Investopedia is kind of like a Wikipedia concept, except for it's just about investing and finance. And Investopedia is just topic by topic, subject by subject, gives you little videos, gives you little tidbits of information that I think goes at a pace and uses terminology that most of us can understand. The other great thing that Investopedia does is it allows you to do a simulator, which just allows you to practice buying and selling stocks if that's what you want to do. It allows you to practice buying and selling stocks without using real money, right? So you can just use fake money, track how it does, track your expenses, see how successful you are with different strategies and different companies that you want to invest in. And so it's a great opportunity to like I say, get your feet wet without putting your hard-earned money at risk, without really feeling comfortable with what you're doing. So Investopedia, I think, is a great tool as far as information, but also simulation as well. So yeah, you definitely could do that. So Marianne, so anyway, it goes on to say that you can also track your different investments that you have online. You can set up financial plans online. There are sites that allow you to go through an entire financial planning process. They give you investment strategy. They give you investment feedback. They analyze what you have, where you're going, how you're going to get to your goals. So there's a lot of resources, a wealth of resources online. As you know, with every single topic now, if you can't, find somebody who can help you, there's always something online, a video online, a tutorial online that can help you with what you're trying to do. Okay, so that's a good way to get started. Another great resource to new investors or to any investor is the FINRA website. FINRA is an acronym for a financial and insurance, service. And basically, what it is it's an investment site. It's a regulator site. Investment professionals actually have this organization that we refer to as a self-regulator. So this isn't a government entity, although the government does oversee the FINRA through the SEC, the Securities and Exchange Commission, that you've probably all heard about. But FINRA is a regulatory body that's actually made up of industry professionals. So if you were an accountant, like if you were a CPA, you have the generally accepted accounting principles, right? The GAAP, which is kind of a regulator, a self-regulator that CPAs have kind of created to help regulate. And then the IRS, of course, has the final word on accounting. The same thing is true with investments. FINRA is a self-regulating body of investment professionals, and SEC has the final word on what happens. But FINRA does a lot of important things, and their website is very helpful. It has a lot of different calculators, it talks about fees, it talks about different scams that are out there. So I think it's a great place to use as a resource just to double check things and to do some extra research when it comes to investing through the FINRA site. So that's another tool. That's an example of what the FINRA site. Zacks is a significant analysis company that you can do different screens. You can screen all these different categories for a particular stock. So if you wanted a certain ranking through Zacks, if you wanted a certain PE, which is the price over earnings, if you wanted a certain dividend yield percentage, there's all kinds of ways to screen for different stocks and then find the stocks that you're interested in. Okay, so let's get to kind of the pros and cons of investing. So, of course, there's opportunity for you to make mistakes online, right? There's not somebody sitting next to you trying to help you do it. So a lot of these warnings just have to do with maybe being a little bit naive or ignorant as far as how investing works and making mistakes with your investing. So for example, if I go online to trade a stock through E-Trade and I trade it and I accidentally put in the wrong symbol for the stock that I want to trade, or I put in the wrong amount for the amount that I want to trade, if I've executed that trade, there's no going back. Okay, there's not a do-over. There's not wait a little bit of time and then you can go ahead and cancel out your trade. Those are live trades. So if I go in and accidentally trade Disney when I wanted to trade DuPont, okay, because they're similar symbols, I actually have to go back in and sell my Disney and buy my DuPont, which means that I'm making 3 trades just to get to the right thing that I was trying to get to. And each one of those trades costs money, right? So it's not something, we got to be very careful. The good news is most sites try to help you to not make mistakes, right? They have usually 2 submit screens so that you can verify what you're doing before you click the final submit. They'll usually tell you the company name in full and the price of that company before you submit, just so you can double check everything. They give you a lot of tools to try to keep you from making mistakes, but in the end, you're in control, right? And sometimes if you're not being careful, or if you're just naive, like I say, if you haven't done it before and haven't practiced it before, you might make a mistake, and that can be costly because then you have to make more trades to make up for it. There's also, of course, unscrupulous people online, just as there are with everything, that are giving bad advice, free advice that really isn't free, because in the end they've got an agenda, right? We all know that if somebody's offering free advice, there has to be some kind of agenda in the end that they're trying to accomplish, whether or not it's something they're trying to sell us or just something they're trying to scam us out of our money for something. There's all kinds of different motives, from online free information. So we just have to be careful we understand it. And the easiest way to trade online and be careful about it is just to make sure that you're using reputable sites. I mentioned E-Trade, but a site like E-Trade, Fidelity, Vanguard, Ameritrade, Schwab, Scottrade, these are all sites that are very well known, that are safe sites to do trading on. If you were to go to a trading site that no one's ever heard of, you just run the risk of being on a site or being with a company that potentially isn't valid, and isn't secure. And so I would just use one of the well-known sites. They've got low costs, low fees, lots of great information, lots of great tools and tutorials and analysis. And so there's plenty of good, legitimate trading sites to accomplish some investing if you chose to do that. Okay. Talks about some other things. There's two basic patterns of information online. There's descriptive information, and then there's analytical information. What you'll find, for the most part, that the descriptive information is the free information, and the analytical information is usually the pay-for information. And how do we differentiate the two? The descriptive information is just information that all of us have access to, that's easy to find, that's public information. For example, if I go to Yahoo Finance, which is a public site, and I click in DIS, which is the Disney symbol, I can find out Disney's financials. I can find out their income statement, their balance sheet. I can find out lots of information about Disney, all their recent news information. So that's all just public information to me. That's all descriptive information. However, if I wanted to know what smart people out there, different analysts and investment companies, had to say about Disney, what their analytical information was, it's likely that I'll have to pay for that information. So if I want to know what, for example, Goldman Sachs says about Disney, because I like Goldman Sachs, I think they're a respectable investment company, then I'll probably have to either pay for a newsletter through Goldman Sachs or open a large account through Goldman Sachs to get that information, to get that analytical information. Now, the good news is analytical information does come free sometimes if you have an account with a place. So for example, if you have an E-Trade account, you might get some of this analytical and analysis information because you have an E-Trade account. But it's usually always linked to something. Either you have to subscribe to something, you have to be a member, you have to be on their trading platform and have investments with them. There's usually a string attached or a cost, just an absolute cost to getting analytical information on companies. But the descriptive information, like I say, usually not a pay-for service, usually not a subscription, usually that part is free. Here's an example of descriptive information on McDonald's. The information's too small though, so I'm not going to go over it. But that's just, if you go to Google and you just put in MCD, it's going to actually give you a McDonald's chart on the stock, and then you can go into Google Finance from there, or Yahoo Finance from that link, and get a lot more information on that company's financials and stock history. Okay, it just gives you some examples of what those look like. Sources of information, you've got lots. Wall Street Journal, Barron's, Investor Business Daily, New York Times. There's lots of places. CNN Money, Dow Jones, Bloomberg. I mean, there's all kinds of places you can find financial information nowadays. And these ones that are listed here are all reputable and have good information. And actually, if you cross-check one from another, like for example, if I went to Google Finance and cross-checked it with Yahoo Finance, I'd find that the numbers are exactly the same, right? When it comes to descriptive information, they're going to be consistent. It's analytical information that we pay for that's going to vary based on who the source is, right? Because that's an opinion about the company, where this descriptive information is factual. Okay? All right, any question about the websites where we can get descriptive information versus analytical information? Any questions in general about, how to get started with investing, how to learn about investing? Just lots of tools, lots of information out there. Pretty easy, actually, and pretty straightforward. Most of you all, at some point in your lives have wanted to find something out, just gone online, found tutorials, and the same is true for investing. You can easily get what you need online these days as far as information. Here's some more example sites. More information, more. There's TV channels, obviously. Here are some different symbols for well-known companies. You might say, how do I know the symbol if I wanted to trade a company? How am I going to find that symbol for a company? Like, how would I know that Nike is NKE or AT&T is just the letter T for the symbol that we trade? And the answer is, it's really easy. If you just Google a company name, say like Amazon.com and then stock, it's going to give you AMZN, and it's going to tell you that that's the symbol. Also, when you go into trading sites, like for example, if you were using Investopedia like we talked about with their trading simulation, you could actually type in a company name and it would actually pull up the symbol for you. So it's very easy to find these symbols. Christine, great question. So why are people willing to pay for someone else's opinions? The answer is that these folks that give opinions there's a reason that they can charge us for it. Either they have a great track record of picking the right, information to buy or sell based on their research, or they're a big company with a team of analysts like a Goldman Sachs or a JP Morgan Chase or a Citibank or Bank of America, and they've got people they can pay to really crunch all the numbers and analyze all the numbers and give us feedback. So you or I, Christine, could look at the descriptive information. We could make our best guess, right, based on the information we look at. But the likelihood of us having a full picture like these analysts would have that we pay for the information from, or the experience like these analysts would have in making investment decisions, is unlikely we're going to be on par with their ability to create an opinion. Doesn't mean we can't, right? And there's absolutely no necessary reason for us to pay for any of those services. I'm not encouraging you guys to go out and start paying for a subscription to something so you can get analytical information. I'm just saying that there is a reason that they have the ability to charge for it, because there are plenty of people who say, you know what, I don't have time to do all the research. I don't have time to make good investment decisions. I'm going to pay somebody else for that information. Okay? Does that kind of answer the question? Or, I mean, the simple answer is you don't need to, right? The descriptive information is out there. The public information is out there. You and I can analyze for ourselves and make a decision for ourselves. But a lot of people will say, I'm uncomfortable making my own decision. I'm uncomfortable that I did all the analysis necessary to come to the right conclusion. So I want to pay, someone else for their opinion as well and their research and analysis as well. Okay, good question. More online information. Okay, you've got some different things, specific things you can do to avoid issues with investing. Just know that when it comes to YouTube videos, when it comes to advertising on all these sites, like if I'm on Yahoo Finance, or if I'm on Market Watch or Google Finance, people are paying them, right, to do ads, just like any other site. They have advertisers, and a lot of these advertisers make their headlines look legitimate, look like they're informative, as opposed to trying to solicit us to buy something. So just keep that in mind when you're on all these sites. Instead of thinking, oh, that's an interesting headline, I'm going to read it and think that it's true, a lot of times those headlines and those advertisers, obviously they're in the business of trying to sell us something. We just need to be aware of that, and don't allow them to dictate what you're buying. Okay, always know what the source is of the information you're reading. Don't watch these 20-minute videos about how the world is going to end and you need to go buy gold and silver. That may be your opinion, but that's a waste of 20 minutes, because we don't know the source when we get into these videos. We don't know, who's really creating this information. All we do know is it's somebody trying to sell us something, okay? And so just take it with a grain of salt. Watch them if you want. Take the time to do it if you want, but just know where you're getting the information from and why it is they're trying to sell you on the idea, that they're trying to sell you on. And then, just this is really, finance 101, but if it sounds too good to be true, if it's a get rich quick type situation, it probably is too good to be true. It probably doesn't work. It probably isn't legitimate, okay? So we can save ourselves a lot of heartache by not responding to the advertising that happens in the middle of the night, the pay-for advertising that happens in the middle of the night that tells us we're going to get rich really fast, or that all our wildest dreams are going to come true if we join a certain company or if we invest with a certain company. The likelihood of that happening is almost zero. And so I just strongly encourage you to make sure and do your own research. Talk to other people, talk to people who have done it before. Don't just jump in because you hope that it's true, something as far as an online investment idea. And I think most all of you are savvy enough to know that, but it's amazing how often I hear stories and have people in my office that got caught, doing something that they shouldn't online with somebody who's unscrupulous and just trying to scam or shiest them out of their money. Okay, so if nothing else, hopefully you got that clear, that we're not going to do that. So here's some questions that you can ask of people online or otherwise to try to make sure and vet out the people who are just, scamming you. Okay. We talked a little bit last week about market indexes, and I tried to explain kind of what they are. Like we talked about the Dow Jones, the S&P 500, and the Nasdaq. And we talked about how the Dow Jones, we hear it on the news, we hear it go up and down, but we really don't, a lot of times know what that even means, that the Dow Jones is going up and down. So here's a great slide. Just says, look, it's 30 of the most high quality diversified stocks that are out there. It's the most popular index for those 30 stocks. And depending on how those 30 stocks do in the aggregate, that's how the Dow does. So if the Dow goes up, it means that on average, those 30 stocks went up. If the Dow goes down, it means on average that those 30 stocks went down. But you can have wild differences, right? So one stock on the Dow, like Boeing, could do really well one day, and the rest of the stocks on the Dow, all the other 29, might go down. Well, then the Dow went down that day, right? No, even though Boeing had a good day, the average went down. And it's just a good indication for people, as we mentioned last week, of where the market's going, how the market's doing. So it's a good gauge for that. And it's been that way historically, even though it's only 30 companies and the market is comprised of thousands of companies. Even though it's only 30 companies, it's been a good indicator of which direction the market's going. So if you hear on the news that the Dow went down significantly, it probably is an indicator that your investments, if they are in the stock market, went down as well, no matter what they are. With some exceptions, of course. Friday this last week, the Dow went down significantly. And so, yeah, a lot of people's investments went down on Friday. Today, the market was closed. Tomorrow, it'll be interesting, after such a bad 2-week period. The first 2 weeks of this year have been horrible on the market. It'll be interesting how the market reacts tomorrow after, having a long weekend. So we'll look to see what the Dow, and the S&P 500 and the Nasdaq do tomorrow, and that'll give us an indication of whether or not the market went up or down. Okay. So it tells you what the S&P is, tells you what the Nasdaq is, tells you about some other indexes that are less popular but also used when it comes to looking at different investments. Here's a chart of the last 2 years, or not the last 2 years. This is old chart. This is about 5 years old, but from 2010 to 2012. In 2011, this dip right here that you see on the chart, that is that actually, and you might not even remember this, but back in 2011, it was the spring of 2011 that everybody thought Greece was going to implode, going to go away. The European Union was going to go away, and so the market really took a beating, that in the spring of 2011. But then it recovered just fine, had a decent year that year. So this is a chart of the Dow Jones and the S&P, and it really is a good reflection of how close they follow each other. Even though the S&P has 500 stocks and the Dow only has 30, you can see how tightly, when one goes up, the other goes up. When one goes down, the other goes down. Okay. Yes, the Dow Jones Industrial usually is not the I don't know what you're referring to on the DJTA. That's usually the transportation index. Okay. But the Dow Jones Industrial Index, that first one, is the one that we're usually referring to, the 30 companies in the Dow Jones Industrial Index. Okay? The average there, excuse me, the industrial average. Okay, good question too. I think we're going to skip over bonds. Just know that you have different kinds of investment brokers, right? You have high-end full-service brokers, you have premium discount brokers, you have different kinds of advisors out there, right? Full-service broker might be somebody who provides research and investment advice. It's kind of like a Merrill Lynch, MSSB, which is Morgan Stanley Smith Barney now, is a big one. Merrill Lynch, of course, is part of Bank of America. They're a huge. JP Morgan Chase is a big one. These are brokers that can basically offer any kind of investments, and they give advice usually as well. Discount brokers like a Charles Schwab or Fidelity or an E-Trade. These are places where it's less costly to execute a trade, but usually folks who are on these platforms are people who are self-directing, meaning they're giving their broker what they want to do, or they're inserting these trades online, and then these are just sites that are accomplishing it for them, just facilitating it, and that's why they cost so much less than a traditional broker like a Merrill Lynch or a Morgan Stanley Smith Barney. Okay, so different types of brokers out there, different ways to accomplish investing. Okay, different examples here, like we just talked about. Different types of accounts. I think that's plenty for chapter 3. So let's briefly look at chapter 4. That'll work here. Risk and return. And let me just give you an overview briefly of what we're going to be talking about with risk and return and why it's so important. And I don't know, like I say, we're going to have a lot of time to dig into details, but the bottom line is this. When you invest, you should be laser focused on both risk and return when it comes to your investing. What will happen in the marketplace and with brokers even is they get caught in the trap of just looking at return. So what happens is somebody comes in and says, hey, I want to invest, and they say, great, I got this great idea. It's Apple stock. Apple's returned, over 300% in the past 7 years. Doesn't that sound great? And the client says, yeah, of course, that sounds like a phenomenal investment. Let's do it. Okay. What's missing from that conversation is a discussion about the risk associated with investing in Apple stock. So let's rewind a little bit and have that conversation again. What if I were to say as the advisor, how long term can you be in this investment? And they say, oh, like 3 months. That would indicate to me as an advisor that Apple stock is far too risky for a 3-month investment. Okay, stocks in general are far too risky for just 3 or 4 months. Stocks in general usually require years, right? 3, 4, 5, 10 years to really accomplish the kind of growth that we're trying to. In a 3-month period of time, they could go down by 10, 20, 30, 50% on us. And if we're not willing to be patient and hold on for the long term, that's a horrible choice or decision to make, right? So that's that risk element that we've got to be aware of. Risk has a lot to do with time frame of an investment. The more time we have, the more risk usually we can take. The shorter the time frame, usually the lesser risk that we can take. Okay, and there's a risk reward, what we refer to as a risk reward trade-off at all times with investing. The more risk you take, the more you should get paid, right? The more return that you should get. The less risk that you take, the less return that you should get. And let's give you a real simple example. If I were to go put my money at the bank in a savings account, I have FDIC insurance, right, under $250,000. So I have a government backing on my deposit that I won't lose my money. So for all intents and purposes, that's one of the safest things that I can do with my money, okay, is put it in the bank. One of the most aggressive, risky things that I can do with my money is invest in very small companies around the world. Okay, and that's considered a small cap global investment. Would be what, if you were to invest in a mutual fund that did that they'd be called a small cap global fund. Okay, so small companies around the world. That's one of the riskiest type of investments that you can make. So you got a bank account on one side, you got a small cap global on the other side of a risk pendulum. Risky, a lot more risk on the small cap global than there is in the bank account, right? Pretty straightforward. So the bank account right now, on average, would pay me 0.2% in a savings account. 0.2%. So not even a percent. In fact, only about 1/5 of a percent each year for holding my money in that savings account. But it's very safe, right? Where if I were to look back over the past 30 years in global small cap stocks, I'd be averaging somewhere between, depending on what category I'm looking at and what manager managed it, somewhere between 12 and 15% on average per year. Okay, some years much better, some years far worse, right? It's gone down significantly some years. But over a 10 or 20 year period of time, those averages are much higher, right? Much higher than a savings account at the bank. And the reason is because I'm taking on risk and I'm getting paid for it. So whenever you're investing in something, know that the risk-reward trade-off is going to be true of any kind of investing. So if somebody tells you I can get you 20% every year, know that you're taking on significant risk, must be taking on significant risk in order to accomplish that. If somebody comes to you and says I can get you 3%, know that you're probably not taking on significant risk to get 3%, right? But you probably are taking more risk than a bank account at 0.2. So a very quick way, easy way to analyze risk and return is whatever the return that's pitched to you, there should be consistent risk with that. So for example, the example that I gave early on about Apple stock, if somebody tells you they can get a 300% return over a 5-year period of time in this excellent stock that they've got, the likelihood is that that stock has significant risk associated with it, or it would not be returning that kind of potential, right? So anyway, that's just something to always know when it comes to investing. Be very careful to always evaluate risk associated with the investment that you're going to accomplish. And if you don't feel like you can understand the risk, it just doesn't make sense, or a broker can't explain it to you, or an investment person or advisor isn't explaining it in a way that makes sense to you, don't do it, okay? Back away. Say no thanks, hold off. Do something that makes sense to you. Don't ever accomplish something just because the return looks alluring and exciting. The risk associated with it's the part that you've got to understand before you jump in, okay? All right, so if you understand that from chapter 4, you have a huge leg up on most people when it comes to being a consumer of investments. They just don't understand this concept of trying to evaluate risks and trying to evaluate how much risk they're actually taking with an investment. They get the return part, right? We all get excited and we can understand how much we can possibly get from something. But when it comes to risk and evaluating risk, that's a piece that we sometimes overlook, and it causes us a lot of grief later on if we do. Okay? All right. So we talked about how return last week on an investment is a composite of both income and or capital gains. So total return is the interest or income we receive in the form of dividends or interest plus the return on the value of it. And recall we talked about how a rental property has both the rents from our renters, right, and also the potential of the property itself to go up. So that would be the capital gain potential on a rental property. Two different parts, and that total between the two is the total return of our investment. In the stock market, if you look back at the S&P 500 and the returns for the S&P 500 over the past 50 or 60 years, it's close to 9% average, okay? Close to a 9% average per year in the S&P 500. Now, once again, this is a long-term average. Year to year, it goes way up and it can go way down. But on average, it's returned about a 9%. Almost half of that return, that 9% return statistic, is dividends, okay? So when we talk about total return of the market, a big part of what we're getting from the market is dividends and interest. It's not just the value going up, it's also the dividend or interest that we receive. And the same is true for a lot of investments, right? Rental property, of course, being an easy one to illustrate, because without those rents, we might not get that good of a return. The value of that property might not go up very significantly over time. But if we get our rents on top of the value increase, that total return does usually tend to be very good over long periods of time. And that's why people like having rental property, just like they like having long-term investments in the stock market. Both accomplish very good returns over time because of both their income and their value change for a total return that's very lucrative in both cases over the long term. Okay? So that's return. Why is return important? Because that's how we keep score. That's how we know whether or not we accomplished our goal or not. Here's an interesting historical set of returns. I don't know if it's even big enough for you to be able to see. Stocks over the past 100 plus years, okay, on average. So stocks in a country like South Africa look really good, right? But what you want is your stocks to go up and your inflation to be low. Why? Because inflation is eroding your return. It's making that return less. What you want is the net return between the two, and one of the highest net returns between the stocks and their inflation is actually the United States. Okay, low inflation rate, average over the past 100 years, one of the lowest, and a very good return on stocks. Okay, interesting chart there. This concept right here speaks to a concept that we talked about a little bit earlier because it applies to your assignment. Time value of money, right? The time value of money is at the heart of the whole present value versus future value conversation, right? That there's the idea of the time value of money is that there's a value associated with time, right? If we have time, we can make more money. If we don't have time, we can't make any more money. So getting our money now gives us more potential over time because of the concept of time value of money, and that we should have more in the future than we have now because money now is worth more than money in the future. So to compensate for that, it needs to be higher. Okay, that's the whole concept of time value of money. Should be part of, it should be integrated into your assignment this week. That paper on future value and present value should have the concept of time value of money because it's so critical to the PV and NV concepts as you look at the assignment. Okay, we talked a lot about investment terminology tonight. We've used a lot of terms that might be new to you. I hope we didn't lose you at any point. Hopefully you're still with us on this holiday evening. Christine, Marianne, before we skip over to the test and look at the questions on the test and give you some notes for that, any questions about anything from chapter 3 or 4? I know we covered it fast. I told you last week that we go pretty quick through material, but I want to get as much of it as we possibly can, especially key concepts, before we wrap up each week. So any concerns or questions, anything that we want further explanation on before we get to the test? Okay, I'll take that as a get to the test. We're ready for it. So couple things that you need to know for the test this week. Like, as I mentioned before, true, false, multiple choice, only 20 questions, but worth twice as much as the week 1 test, so 100 points instead of just 50 like last week's. So one of the things that you'll note in the first 10 questions, because it is a midterm, the first 10 questions are almost, I think there's a lot of repetition between the first 10 questions and what you did last week. So hopefully you'll feel comfortable with those. Hopefully you kind of took a mental note on ones that you got right or got wrong so that you'll do well this week on the first 10 questions. Number 1 on the test asks you to understand the concept of an investment. Okay, and we kind of defined last week what an investment is. Investment is something that you expect to get some kind of return from. So let's think about that. If you put your money under the mattress, do you expect to get a return? No. So it's not an investment, right? Putting it under the mattress is not an investment. It might be a safe place, might be a good thing to do, but it's not an investment. If I put the money in a bank and the bank pays me interest, then that is an investment. You might not think of a bank account like a checking or savings account with interest as an investment, but it is. If it gives you interest, it's getting you some kind of return. So anything that has an expected return can be termed an investment. So you'll need to understand that for number 1 on the test this week. If it doesn't have an expected return, it is not an investment. If it does have an expected return, it is an investment. Number 2 on the test asks you to define what real property investments are. So what are real property investments? You have stocks, okay? Those are like intangible investments. You can't really feel and touch a stock investment, right? The company that you're investing in. It's kind of it's an entity, but it's not something that you can go out and feel and touch. On the other side, if I go invest in a rental property, okay, or a commercial property, that is a real property investment. Okay, just a different, something I can touch and feel. That's a real property investment. Okay. Number 3 on the test, we want to understand what a U.S. savings bond is. A U.S. savings bond is a debt of the federal government that they are going to pay us back interest over time, and we are supplying money to the government. They're going to pay us back over time with interest. So I buy a savings bond. That's in effect lending money to the federal government. They're borrowing it from us. They're going to pay us interest and give us back our money over time. That's what a U.S. savings bond is. So based on our definition of investments that we talked about earlier, is a U.S. savings bond an investment or not? Marianne or Christine, you want to take a stab at that? Based on our definition of an investment being something that we can expect a return from, is a U.S. savings bond an investment? Good, Marianne. Yes, it is, because we're expecting to get interest, right, on the amount that we let the federal government borrow from us. That's what a savings bond is. So if we expect any kind of return, whether it be interest or value gain, then that's an investment. So you got number 3 right on the test. You'll be great on that one. Number 4 on the test, You need to understand the difference between mutual funds and stocks, how they trade. So mutual funds trade once a day at about 2 p.m. Eastern time, about 2 p.m. our time, about 4 p.m. Eastern time. So once a day at about 4 p.m. Eastern time. Stocks trade all throughout the day, right? As soon as the stock market opens in the morning till it closes in the afternoon, it's trading. Their stocks are continuously trading. But mutual funds only trade once a day. Keep that in mind. Make a note of that for the test. Make sure you understand what institutions are, what government is, what individuals are. Recall last week that we talked about institutions, individuals, and government as three different main categories for suppliers or demanders of funds. You're going to see that again on the test this week. For number 5 on the test, you just need to understand what some examples of institutions are. Okay. Number 6 on the test, we just want to make sure we understand what debt is, and we talked about that last week. Debt and bonds. Debt and bonds and fixed income are all can be used interchangeably. All they are is an agreement for one person to borrow from another and then to pay that person back over time with interest, right? That's what debt is. That's what bonds are. That's what fixed income is, okay? Interest over time and then a repayment of the principal balance. Number 7 on the test and number 8 on the test go back to net suppliers versus net demanders of funds. Recall that government and institutions are one side of the coin and individuals are the other side of the coin as far as demanders or suppliers. And I'm not going to tell you, but just go ahead and make note of that again, that you're going to see that twice this week on the test in 2 different ways. And just make sure you know for yourself which ones are which ones are demanders of funds and which one is a supplier, net supplier of funds. Number 9 on the test just asks you to identify what trades in security markets, so you'll need to know what trades in security markets. Number 10 on the test is going to ask you, among different examples, which one is most liquid. This is a question that we saw in last week's test. If you're looking at different investment choices, you'll need to be able to just glance at it and be able to analyze which one is the most liquid or which one is the most short term. That's another way to look at it. What is the shortest term investment among the examples that they give? And there was a graphic on last week's slides, if I'm not mistaken, that kind of gave you an example of short-term investments versus long-term investments. But you should be fine on that one. It's just a review of last week. Number 11 on the test. Number 11 on the test talks about a concept from chapter 3 that we kind of brushed over pretty fast tonight, which is brokers and whether or not they charge higher commissions or lower commissions for online trades versus telephone transactions. Just know and just assume that if anything happens online, it's going to be lower cost, okay? And you'll get that one right on the test. Anything that happens online is usually lower cost than if you have to call someone or talk to someone in person, right? And that's consistent almost with everything, right? Online things are usually less costly. Number 12 on the test talks about online trading, the pros of online trading. So there's a couple graphics from chapter 3 tonight in the slides that talk about the advantages of online trading. So if you familiarize yourself with those, you'll get number 12 on the test right. Number 13 on the test talks about descriptive information. Remember, and you'll be fine if you know descriptive information is free usually, right? Like we talked about. And that would be like charts and graphs and stock information. All that stuff is free descriptive information out there. Then there's analytical information that's usually subscription-based, and it's usually pay-for service. And if you understand the difference between those two, you'll have number 13 right on the test. Number 14 on the test talks about another advantage of online resources that are out there. We talked about a lot of different things that you can do online, but number 14 just specifically talks about something that you can do online that was mentioned tonight during the session. We did show you a couple slides on different things that you can accomplish online. If you just take note of that, you'll be good to go. Another advantage or resource of online of the web. Okay. Number 15 on the test is a concept that I mentioned, which is the idea that if you make a trade, okay, and you make an error, recall that there's not a grace period. There's not any kind of time that you can wait to just make it right. If you make an error on a trade, it's final. The only way to reverse the trade, which you can't really reverse it, but you just have to go in and sell what you traded wrong, and then trade again what you should have traded in the first place. So it's not really, it's a way to correct it, but you have to manually go in and make multiple trades to correct your problem. You can't just reverse what you did. Okay, so that's an important concept in number 15 on the test. Make sure that you understand that. Number 16 on the test is basically the concept of annual percentage rate versus APR versus APY, annual percentage yield. I don't know if you've studied this in finance classes, but basically you have an annual percentage rate and an annual percentage yield that is exactly the same as long as the interest only compounds once annually. But if you have interest that compounds more often, then your APY will be different than your APR. Okay, and I know for some of you, if this is the first time you've ever heard of that, that might be a little too fast to cover that, but just make sure that you understand why it is that APY and APR can be the same when it compounds annual, when interest compounds annually, but a lot of times it's not the same because of different compounding. So it could be daily compounding interest, monthly, quarterly, semi-annual. You could have different compounding interest, and that makes the APR and the APY different. Okay, or the stated rate, which would be the APR, versus the true rate, which would be the APY. That's the terminology that the test uses: stated rate and true rate. True rate, like I say, would be like the APY. Stated rate would be like the APR in our example we just gave. Okay. Number 17 on the test. Just make sure you understand the concept of discount rate. What is the definition of discount rate as it pertains to annuities? Okay. So as it pertains to annuities, what is the discount rate? Okay. Number 18 on the test is another question about discount rate. Okay, so just make sure you understand discount rate, two different problems. Number 19 on the test asks you, what is an example of something that would lower the required rate of return? Let's talk about required rate of return just briefly. Required rate of return is me pre-establishing what kind of return I want to get from my investments, and I create some threshold of required rate of return. Usually, it's a concept of the risk I'm willing to take and inflation. Okay, so if inflation's at 3% and I'm willing to take risk, my required rate of return might be 8%, right? I want to get 5% better than inflation. Okay, so that's an example of a required rate of return. So when you get to the test question number 19 on the test and it asks you what will lower the required rate of return, either I want less return from the risk I'm taking, I want to take less risk, or inflation is lower. So one of those two things has to happen for me to have a lower required rate of return. And if you understand that, then you'll get number 19 on the test right. Number 20 on the test just asks, what would decrease a rate of return on an investment? So what among a list of 4 different options on the test, what among those options would lower our investment return? Okay, so there's all kinds of things that could lower our investment return, right? Things could go wrong. Somebody could be scamming us. The investment could have more risk, and the risk could work against us. But there also could be things like inflation and taxes, and we just need to understand what affects our returns. So chapter 3 and chapter 4, if you'll just zip through the slides, I think you'll find a slide or two on this concept of the types of things that decrease our potential return and the types of things that increase our potential return. And that will help you to get number 20 right on the test. Okay? All right, those are the 20 questions on the test, all true, false, or multiple choice. No short answer. Shouldn't be significantly difficult. Okay? Should give you the benefit of the fact that 10 of the questions are almost exact repeats of last week, so you should feel very comfortable with at least half the test. And then if you've taken notes from tonight and kind of reviewed the material, I think you'll feel great about the second half as well, because they're concepts that if you just do a little bit of research on, you'll be in good shape. Okay. All right. Any questions before we wrap up tonight? Once again, Christine, Marianne, thank you for being here. Appreciate your participation. Sorry it was a quick and fast and furious. I didn't ask you nearly as many questions as I normally do to get your participation, but I knew there was a lot of material and wanted to make sure we got through it all. So have a great night. Zip me a quick email if you've got any questions or concerns about the material this week, Good luck with the coursework, and we'll talk soon. Have a great evening. Have a great night.